and welcome. You're watching live session on the economic outlook for India, powered by Investonomics and initiative by ICICI Securities. Joining me now is Mr. PK Basu, Chief Economist at ICICI Securities. So very good evening, sir, and welcome to the show.
Good evening, Gitu.
Mr. Basu, if we talk about the major events for December, your RBI policy, your Fed policy, it's now over. We saw 35 bips hike by RBI. We saw 50 bips hike by Fed. So how do you see 2023 now as far as the interest rate scenario is concerned?
Well, I think in 2023, we'll see the peak in US interest rates. I expect that peak will be reached in March. At the March FOMC meeting, we should see the Fed funds rate go up to 5%, and that should be the peak. Although the FOMC median forecast is for the Fed funds rate to end 2023 at 5.1%. Yeah. I think they are a little bit overdoing it now, in the sense that they've been very behind the curve for the last year and a half, and now perhaps they're overcompensating on the other side. With regard to RBI, I think that the last 35 basis point hike was the end of the hiking cycle this time, given that we now have a moderation in CPI inflation and WPI inflation. Both are below 5.9% now year on year. And in particular, I think WPI, the moderation WPI is quite dramatic. It's moderated from around 14 or 15% earlier in the year to 5.8% now. And that is reflective of the fact that energy inflation is moderating, crude oil prices are coming off, and also, of course, food inflation has moderated, exactly as I was expecting. I've been saying for several months now on this show, for instance, that we would see a moderation once the Rabi harvest came in November. The November inflation rate would moderate, and that's essentially what's happened. It's moderated already to below 6%. And from here on, the base effects begin to help even more, because in December last year, the inflation rate was 5.6%. And from January to October 2022, inflation was above 6%. So relative to that high base, I think it's very unlikely that we'll see inflation stay above 6% at all over the next few months. In fact, if anything, December and January will see the inflation rate for CPI moderate considerably, perhaps to around 5.5 to 5.6% in December, and much closer to 5% in January. Once that happens, it reduces the need for the RBI to tighten any further. Now, the interesting thing is that at the same time as this is happening in India and the US, we saw the Bank of England tightening policy as well. Right. And in a big surprise this week, the Bank of Japan widened the trading band for its yield curve targeting policy. The yield curve target basically was to be 0 to 0.25%. That's been widened to 0 to 0.5%, and bond yields quickly began to move above that 0.25% mark towards 0.5%. So that was effectively a tightening of monetary policy by Japan, the first tightening in many, many years. And that was a real surprise to markets, but that basically means that there's been a global tightening that is now underway. And Japan has also joined. Now, the key implication of all this, I think, is that the period of dollar strength is over. In fact, it ended about 7 weeks ago. And now the dollar is basically losing ground against most currencies. it isn't losing ground against the rupee. You'll notice that the rupee, in fact, has held steady
Right.
in a fairly narrow range against the dollar over the past 6 or 7 weeks,
Mm-hmm.
while the dollar has depreciated. So, in effect, the rupee is depreciating against currencies like the euro, the sterling, the yen, the Korean won, the Chinese renminbi. Those currencies uh, had depreciated a lot against the rupee earlier in the year.
Mm-hmm.
The yen had depreciated around 25% against the rupee.
Right.
So with that big depreciation, those countries, which many of which are really competitors to India in export markets, they had gained a great deal of competitiveness. So India is now using this opportunity of a relatively weak dollar against its basket to to stay stable against that weak dollar, that weakening dollar, and
Mm-hmm.
thereby regain some competitiveness against those other currencies. So what you find is that already year
Mm-hmm.
to date, the euro is up slightly against the rupee. That would
Right.
have been shocking thing to say even 2 or 3 months ago. The
Mm-hmm.
euro had depreciated more than 10% against the rupee until September. But since then, the rupee has given up all those gains, more than given up the gains. It has given up some of the gains against most of the gains uh, against sterling and against the Korean won and the Chinese renminbi.
Mm-hmm.
The only currency that is still, I mean, of course, the yen has just started this week uh, uh, to appreciate, and as a result, year to date, the yen is still about 10% weaker against the rupee. So the important point is that this has been a nice period for India in terms of regaining some lost competitiveness for its exports.
Mm-hmm.
And for the export story, we've also had the removal of most of the export duties on on steel and steel products. In
Mm-hmm.
fact, that was done on the day we had our last such event,
Yes.
um, uh, Investonomics, and on the 22nd of November. And as a result of that move, we are now in a situation where we should begin to see India's exports do a little bit better because
Mm-hmm.
about 10% of exports are steel and steel products. So the export duties there were really uh, having a debilitating impact on
Mm-hmm.
engineering goods exports in particular. Those should now rebound, and so that's a pretty positive environment. Now, the other aspect is that once the dollar uh, stops appreciating, that's generally good news for emerging markets,
Mm-hmm.
because what you find then is that emerging markets uh, begin to see more inflows.
Sure.
And in the period from July to November, India has seen significant net inflows of portfolio capital, and emerging markets in general are seeing inflows too. So that's a pretty nice environment for India to be in at a
Mm-hmm.
time when global liquidity is tightening. India's inflation rate has come off, and the need for India to tighten any further, I think,
Mm-hmm.
has largely gone away.
Mm-hmm. Mr. Basu, while we are speaking about inflation cooling off, we have China going through COVID crisis yet again. If the crisis wasn't there, then we have supply side constraints again, which might lead to inflationary pressures going forward. So, what is your assumption as of now? Because we're not sure what is happening in China.
Yeah, the China news is really very difficult to decipher at the moment, because if you look at the official numbers from China, the COVID numbers are down, but reports, newspaper reports in the Financial Times, the Guardian, the Economist, many other international publications are
Mm-hmm.
reporting from the ground saying that there is a massive outbreak of COVID in Beijing in particular, and pretty much across China. So this is really the first serious outbreak in Beijing. there appears to have been, problems in many other cities. In fact, people in Beijing and Shanghai are reporting that almost all people in the office are ill in places like the Amazon, Facebook office. Well, not Facebook, but Amazon office and some other offices in Beijing are largely seeing almost everybody falling ill. It's the sort of thing that happened in India in April, May last year when we had the second wave. When you could hear in Delhi, you could hear sirens, ambulance sirens going off almost incessantly. That sort of thing apparently is happening in Beijing at the moment. But the reported numbers from China are actually down a bit in the last week. So I think China's potentially shooting itself in the foot by not reporting things properly. China doesn't have serious immunity, doesn't have herd immunity. And if there is a serious outbreak in China, then over the next 2 or 3 months, we could have many hundreds of thousands of people a day falling ill with COVID in China, and that could result in significant supply disruption, as you correctly point out. But in a sense, this is a good opportunity for alternative suppliers to jump in and gain market share. And those alternative suppliers would include India and ASEAN in particular. So within ASEAN, the likes of Vietnam and Malaysia, Singapore, etc., would take up some of the slack. I don't think they can take up all the slack because China has become the dominant manufacturer of almost everything in the past decade and a half, and the ramp up of electronics capacity in India, for instance, is just beginning. If you look at textiles and garments, India's exports of textiles and garments have been more or less stagnant for a decade now. And so there's an opportunity for India to really ramp that up, but it would require new capacities to be created, or capacity utilization in existing capacities to jump very quickly. All of that is difficult to accomplish in short order. So yes, I mean there could be some disruptions to global supply from China, and that could have a secondary inflationary impact in certain very specific areas, things like textiles, garments, shoes, toys, etc. The entire labor-intensive space, and a little bit in electronics. But in electronics, I think there are alternative suppliers. There's the whole of South Korea, Taiwan, Singapore, Vietnam, and now India could take up a lot of the slack, and in the older places, ramping up regenerating older capacities. In India, ramping up newer capacities that are already underway and just speeding up the investments in those capacities. All of that will help to, I think, moderate things. So I'm not yet too worried. Of course, if there is spillover from China to the rest of the world, then of the pandemic, then we have a much more serious problem. But at this stage, I think most of the rest of the world has very good immunity. Certainly in India, the herd immunity is high. I think people will soon be urged to take another booster dose, the fourth. But for most of India, most Indians have already taken not only 2 doses of the vaccine, but generally 3. So about 2.2 billion doses of the vaccine have been administered in India, which means that pretty much everybody has had 2 doses. Many have had 3, and I think people will now be urged to take a fourth dose. But the point is, there's also herd immunity, because large proportions of the population have had COVID apart from taking the vaccine. So in China, it's slightly different. There's been a ramp up in Chinese vaccinations as well. Until about 3 or 4 months ago, it was reported that between one third and half of all those above 60 had not been vaccinated in China. That has changed. China's numbers are now, for the above 60s, more than 90% apparently have at least had 2 doses. But it is really the extremely old, those above 80, who have very low levels of vaccination. And that's where the greatest risks lie, the greatest risks of contagion, but also risks of death and hospitalization, which are the sort of things that cause problems in healthcare systems in the midst of COVID. So yes, I mean, there are risks, very considerable risks arising from this emerging outbreak in China, the exact contours of which are still very difficult to decipher.
Mr. Basu, we talk about China plus one strategy, but are you satisfied with the kind of measures that our Indian government has taken to promote exports? We have PLI scheme in place, but that is going to fructify in next 1 or 2 years. Capacity additions are, in works, but to give a real boost to exports is still lacking.
Yeah, well, I think what is needed is for Indian companies and manufacturers to step up to the plate. I mean, I think the government has done quite a lot. The government has come up with a PLI scheme that is very attractive. It has cut corporate tax rates to globally competitive levels, and it has also reformed the labor market, made the labor market much more flexible. So all those things have created a much more propitious environment. Now, what is required is for businesses to respond, and businesses remain cautious, I think, for the simple reason that there has been a glut of global capacity coming from China. China has created a glut of capacity in steel, aluminium, cement, automobiles, chemicals, solar panels, you name it, low-end semiconductors. So in all of these areas, China has overinvested over the last 25 years, and has basically crowded out the rest of the world's investment spending, and has made businesses very cautious about a new capex cycle. So that caution is slow to recede. That caution remains in place. Indian corporates, like corporates in many other parts of the world, are wary of ramping up capacity and then being swamped by imports from China, or a slump in prices resulting from a glut of exports from China, which is what happened about 7 or 8 years ago in a lot of these sectors, in steel, aluminium, etc. And of course, has occurred over the last 3 or 4 years in solar panels and modules. So it is a difficult environment globally still, but if China is significantly debilitated by this emerging crisis, and if its overcapacity gets exacerbated by this collapse in domestic demand. I mean, in fact, at the moment, domestic demand is weakening in China because China is seeing a lot of lockdowns and various kinds of restrictions that are arbitrarily being put in place by local governments city governments, etc. All of that is actually having uh, a, a big dampening effect on demand in China. And if demand in China, within China, weakens, then you could have a serious banking crisis because there's already huge overcapacity in the property sector. There's overcapacity in almost every major industrial sector. And if there's no domestic demand to take that up, then China is really going to be in serious trouble from a financial sector perspective. So if the financial sector is debilitated, then it becomes difficult for the banks to keep financing new capacity additions. So, but this is going to be a multi-quarter process at least. It's not going to occur immediately. China is potentially on the brink of a very serious crisis. And if that crisis occurs, then I think there's an opportunity for the rest of the world to invest. And I think Indian corporates would be well advised to jump in at that point. Now, so far, the evidence of a revival in investment spending in India is there, but it's modest. I would say that it is much more modest than would be ideal. But if the next decade is going to be India's decade, then the first thing that has to occur is a significant ramp up in capacity, new investment spending, new capex cycle by the Indian corporate sector. And I'm waiting for that to happen, but it's not really happened yet.
One important development that is happening, as far as the Ukraine-Russia is concerned, we have Ukraine's Zelensky meeting President Biden, and then we have a statement from Putin saying that Ukraine conflict is a tragedy, but not Russia's fault. So where are we heading?
Well, I don't think there's an immediate early end there. The Ukrainians are certainly not about to end the war at this point and agree to freeze the borders where they currently stand. So during the winter, it's very difficult for any military to make advances in that region, in Russia, Ukraine. Napoleon and Hitler were stopped in the winter, and they were defeated primarily because at the time Russia and Ukraine were one, and there was Napoleon was defeated by a scorched earth policy, basically destroying all the crops in Ukraine, what is now Ukraine, and similarly with Hitler to some degree. And so it is very difficult to fight a war and win a war during the winter months in Russia and Ukraine. It's difficult for forces to advance. So potentially there is the prospect of a peace deal being agreed during the next 2 or 3 months. But at the moment, neither side is really too keen on it. I think in the West, there's a degree of fatigue in many parts of Europe in particular. The Europeans, local populations in Europe are fatigued by the war. They are seeing the consequences in their electricity supply now. So there is growing opposition to the war in Europe. But the US continues to try and fund the Ukrainians, and the Ukrainians themselves, as you could see and hear with Zelensky's speech to the US Congress yesterday, Zelensky is in no mood to give up. So if Ukraine isn't giving up, Russia isn't about to surrender, then the war continues, unfortunately. And the only good news from an economic standpoint is that the worst is probably over in terms of disruptions to supply of oil of grain, fertilizers, etc. Things that and oilseeds, the items that come from that region are now flowing relatively more smoothly, and and as a result, the inflationary impact from there is quite muted. Also, we are close to a year into the war now. We're just 2 months away from the first anniversary of the war, and so base effects will help with inflation pretty much around the world. We've seen that also in the U.S. inflation numbers. The latest moderation in inflation occurred over the last couple of months, and going forward, U.S. inflation will also be benefiting from the high base effects. So, so I think we're past the turning point. Things should get better, but I don't see an end to the Russia-Ukraine war anytime soon, unfortunately. If that were to happen, that would be the best news of all, but I doubt that'll happen.
Mr. Basu, we just mentioned that this decade belongs to India. So what are the three key structural changes that you think will make India the best economy, the best performing economy in the world in this decade? And what makes you so optimistic about India?
Well, there are many structural factors helping India now. Most important is the demographics. We still have a very young population, and we will have we'll have that youth bulge coming through over the next 15 to 20 years. And so during that period, what basically happens is that a nation's savings rate usually rises, because as people, as a big chunk of the population goes from being outside the working age group, that is students, to becoming earning adults, the national savings rate automatically rises. It's quite simple. When you're a child and going to school, you are a net dissaver. You consume, you don't earn any income. As soon as you are an earning person, you have an income, the national savings rate, your personal contribution to the national savings rate goes up. You go from being a dissaver to being a zero saver, or soon a positive saver if you're earning a bit more and able to save some of it. So that phenomenon helps boost savings rates, and as savings rates go up, investment goes up. So this is the phenomenon that helped Japan from around 1960 to 1990. It helped Korea from about 1975 to about the year 2000, 2005. It helped China from 1978 to 2013. That was the period when its dependency ratio was falling. Now, India's dependency ratio is going to be falling for at least the next 15 years. So that structurally, that is the most beneficial aspect that will help generate higher levels of saving and consequently higher levels of investment. And if you invest more, you can generate higher productivity growth, and that growth and productivity ultimately boosts incomes and well-being. So that's the first thing. Second is that we have a very propitious political environment, policy environment. The policy environment has essentially ensured that we have now, for the first time ever, India's corporate tax rate is competitive with the rest of the world, particularly for new manufacturing units. And I think the third factor, of course, is the labor market. The labor market is now becoming much more flexible. So those three things are structurally very important, and should ensure that India grows India becomes the fastest growing economy in the world over the next decade, as it has been for 5 of the last 8 years.
Right.
Now, those 5 are the first 5 years in the last 75 in which India was the fastest growing economy in the world. I mean, among larger economies, G20 economies, India was never the fastest growing until these 5 of the last 8 years. And in the next 10 years, for most years, we should be the world's fastest growing G20 economy. Um, so now the question is, are we going to grow? We are going to grow the fastest, but is that going to be 6.5% growth annually? Is it going to be 7.5% growth annually? Or is it going to be 9% growth annually? If it is 9% growth annually, then it's going to be transformative of lives. Very quickly, you begin to see the spread of prosperity across the country. We have more or less conquered extreme poverty. Extreme poverty is gone in India, but what is required is for relative deprivation, relative poverty levels to also be gradually removed, so that there are no really poor people anymore. And we are very far from that point. I think we have at least, I'd say, 10 to 15% of the population is still very poor by global standards. So that's one. The second thing is that our per capita income levels are still extremely low. So we do need to grow rapidly and preferably close to 9% and more than 6.5 to 7%. So if you look at consensus forecasts, they're looking at 6.5 to 7% growth in the near term. My current hunch is that we'll be somewhere between 7 and 8%. But I would prefer, of course, we would all prefer to see much faster growth than that. 9 or 10% is conceivable. It is conceivable because the demographics are on our side, because the policy environment has improved a lot. And what we now need is governance to improve pretty much across the board. We need the pockets of bad governance to be reduced. And I'd say that, things like the judicial system, the fact that the judicial system does not deliver justice to the vast majority of people most of the time, those are things that also need to be addressed if we are to move ahead quickly. And of course, the external environment will have to be managed carefully, because the simple fact is that we have a rival power in Asia that is not happy to see us prosper. If you look at what Mao said to Nixon and Kissinger in the 1970s, the astonishing thing, when Nixon and Kissinger were talking to Mao in 1971, 72, 73, they were flabbergasted by the fact that Mao wanted to spend more than half the time talking about India. The Soviet Union was, the Americans wanted to talk about the Soviet Union and how America and China could get together to counter the Soviet Union, which was then a really important rival power for both China and the United States. So that was the convergence that they were talking about. But Mao wanted to talk about India. So I think the Indian security establishment should read Kissinger's books about that period first to understand, and I would recommend it to people like Shiv Shankar Menon, Shyam Saran, and all, the people who have been at the top of the foreign policy establishment in India during the Congress period. They really should read those things more closely. I'm sure they've read them, but they've ignored what they've read rather than absorb it. Because the simple fact is that we have a very difficult neighbor, and countering that neighbor is going to be the major challenge of the next 20 years. If we counter that neighbor effectively, build alliances with the likes of Japan, the US, Australia, perhaps the UK, and the EU, then if we can build strong alliances that enable businesses from these countries to think of India as a genuine alternative to China, and to invest in large-scale manufacturing of all the products that currently are focused entirely in China, then we could begin to really see the sort of 9 to 11% annual real GDP growth that would leapfrog us from being a low middle income country today to being a high middle income country in about 10 to 12 years. And that transformation, now, I'd say that China today is already high middle income. China is a relatively prosperous country. Its cities are comparable with the best in the world. That transformation really took off in the 1990s, and it began with Shanghai. But if you go to places like Zhuhai, Guangzhou, Beijing, Shanghai, of course, you find a level of infrastructure that is far superior to what you see even in the most prosperous Indian cities. So we do need governance to improve. Mumbai, for instance, our financial capital, sadly is an eyesore. I mean, it has some magnificent buildings. It has some amazing buildings. You go inside, the building is fabulous. From the outside, the buildings look tremendous. But the infrastructure leading up to the building, the roads, the pavements, they are like they almost are like village roads. So that sort of urban decay on the ground will need to be addressed effectively over the next decade. So while I am optimistic and I think that India is extremely well positioned to prosper over the next decade, there's a wide range of outcomes. If you have 6% growth annually, you double incomes in 12 years. If you have 9%, if you have something like, say, 12% growth, you will double incomes every 6 years. So that makes a massive difference. If you double income 6 years, then in 12 years you have a quadrupling. I mean, that sort of transformative change can occur if we get our ducks in order and make sure that that we achieve the best outcomes possible. And the best outcomes will require closer alliances between India and our key trading partners around the world. So India with the United States, Japan, the EU, the UK, all of this, and eventually we will then need to be able to also look at markets in places like Africa. Now, Africa is now beginning to emerge. Now, this year, if you look at Africa, we've had, just last week, we had Ghana defaulting. We had Zambia defaulting a couple of years ago. We had our neighbor Sri Lanka defaulting on its sovereign debt. So, these are potential partners of ours in the future. If you look at, say, Zambia, right? I mean, Zambia is a major copper exporter. Most of Zambia's copper is owned by an Indian company. Vedanta invested in the copper mines of Zambia about 15 years ago, 17 years ago, and remains a very important player in that economy. But we need to be able to take advantage of these business tie-ups that exist, build on them, and over time develop a deeper relationship that is mutually beneficial for India and Africa. So at the moment, of course, if you look at Ghana and Zambia, now Zambia in particular, about 25% of GDP is their debt owed to China. For Ghana, it's about 10% of GDP. So they are extreme. One of the reasons why they got into trouble is because they over borrowed from China, and China was lending because China was inexperienced in foreign lending, and over lent to them. Mm-hmm. Now, China is participating in debt restructuring arrangements in the Paris Club, the London Club, and so on. And China is very inexperienced in doing this, but China has put in place some imperial clauses, the sorts of clauses that the British the French, and so on used to put in the 19th century. When they lent money to a country, they would say, okay, if you can't pay this money back, you're going to have to give up some of your land to us. China's put in the same clauses, as we know with Hambantota in Sri Lanka.
Yes,
it has similar clauses in with the Democratic Republic of Congo and many other places, where it is slowly acquiring land in those countries, and that is causing a lot of resentment. So, from a political standpoint as well, I think there's a good opportunity for India to build relationships with countries that are disenchanted with China. We cannot lend to them as alternatives. We must not. In fact, it is foolish to lend to an over-leveraged country. Stay away from that, but build other relationships, build other commercial relationships, trade, exports and imports. And of course, with Sri Lanka, India has stepped into the breach. But unfortunately, when you step into the breach in this way, and then the country defaults, all creditors will now have to take a little bit of a haircut, including us. There's no getting away from that. So we need to be cautious about becoming an aggressive lender to other countries. Certainly stay away from that, but deepen other types of relationships. Particularly with our neighbors, and Africa is a neighbor of ours just across the seas. Africa is one neighbor, the Southeast Asians are the other. So as we build these relationships, we are actually quite well positioned geographically to play a part in building links between, say, building across the Indian Ocean region, for instance, which is an obvious area where India should be commercially as big a player as it continues to be strategically.
Year 2022 is coming to an end, Mr. Basu, and as far as the Indian economy is concerned, Indian equity markets are concerned, there's clear outperformance. What is your outlook for the year 2023 as far as the GDP numbers for India are concerned? Because we have one more quarter to go for 2020 FY23, and where do you see the equity markets?
So with regard to the economy, I think this year we'll have about, this fiscal year, real GDP will grow around 7.5%. That's above the consensus. Consensus is now looking around 7. You'll notice that the World Bank recently raised their forecast from 6.5 to 6.9%. I have stayed at 7.5 right through the ups and downs of these forecasts. I see no reason to change that. For next year, I think, given the global recession, we'll probably see a little bit of a slowdown for India. And we'll see a slowdown primarily because, so slowdown to about 7.2, 7.3% for next fiscal year, partly because of the global deceleration. Okay. But if the CapEx turnaround gathers pace, then next year could be faster. My baseline scenario is around 7.3% for next year. my positive risk case would be 9% growth, and 9% growth though will only come through if you get a really powerful recovery in fixed investment spending. As I'm saying, that is not my baseline, because unfortunately, evidence of a genuine pickup in investment spending is not there. Evidence of a really optimistic and confident corporate sector is not widespread enough. We have several large corporates who are confident about a big boost to investment spending, but it will not suffice to have a few big corporates doing it. We know that the Tata Group, Reliance Group, the ArcelorMittal, and their joint venture partners in India, Nippon Steel, are going ahead with some very aggressive investment plans. Right. We know that some car manufacturers are potentially looking at a ramp up, but we need that to be a much more widespread phenomenon, and that widespread phenomenon is not yet fully evident. So, until I see clear evidence of that, I will stay with my baseline scenario. Now, with regard to the prospect for inflation, interest rates, etc., I think that we are likely to see the Fed cutting rates by July next year. I expect to see a cut in July, primarily because inflation would have been defeated by them, in a sense that the core PCE inflation rate in the US should be around 2.5%. I'm looking at India cutting rates by September. And so with that, you should begin to see a cyclical turnaround that helps the investment recovery to gather momentum. Now, if China has a financial crisis, that'll be the best news for the rest of the world, for the simple reason that then China will have to focus on its domestic challenges. The domestic challenges will be similar to what Japan faced after its bubble burst. So Japan had a 2-decade-long period that is called the two lost decades, and China could well face something similar. But China so far has averted that fate, partly because China has been willing to keep funding new investment spending over time. And even now, there is an attempt, Chinese government has okayed support packages for the largest property developers in China. So if the largest property developers are successfully rescued through this, then China can postpone its troubles. But the next 2 or 3 months will determine. I mean, I think in a month from now, if China is still in the throes of a severe COVID-related crisis, then it will not simply be a COVID crisis. Because if there is a COVID crisis that goes on for the next month or two, then you get into the Chinese New Year period, and during that period, if there's a collapse in property prices, then the Chinese banking system will be in deep trouble. And it'll not be that sort of trouble, is not something that a government can easily come and rescue banks from. It's possible to rescue them. It's possible, if governments try to rescue banks that are in trouble repeatedly, then they can just postpone the onset of a crisis. But I think there is a recognition that continuing to do that now is going to be potentially disastrous for 2 or 3 years down the road. And so, so I think the next 2 or 3 months are potentially the most crucial for China. And if China does have a full-blown financial crisis, then that obviously creates a huge opportunity for India to play a leading part in getting the world out of that crisis. And what will happen then is that essentially there will need to be a significant ramp up of labor-intensive manufacturing capacity in India, Vietnam, Bangladesh, Southeast Asia. There will have to be a ramp up in electronics capacity in Korea, Taiwan, Southeast Asia, and India. So all of that will happen. Now, right now, for instance, you find that the global electronic cycle is turning down. Demand is down. But India's electronics exports are up. Even the latest month, they were up 54.5% year on year. So actually, this is a sign of weakness for Indian electronics. What it basically tells you is that India is such a small player in electronics that the global cycle is irrelevant. We are still ramping up from a very small base. So that's fine. But at least we're ramping it up. At least for the last 3 years, we've seen electronics really do well. And we're seeing the first early phases of a significant ramp up in electronics capacity in India. But we are still effectively price takers in most of electronics. So we can keep growing quite rapidly until we have, say, 20% market share in global production of smartphones. We will not be really affected by global cycles because we are simply gaining market share from others who have 95% of the market. We have just 5%. So we're slowly gaining. Now, so electronics is one area where we are succeeding. Textiles and garments are one area where we are failing. This cannot go on. You cannot continue to fail in labor-intensive manufacturing. We have failed for 25 years. We cannot afford to fail in the next 5 years, the next 3 years. So what we really need to see is labor-intensive manufacturing gathering momentum. And if China is facing a banking crisis, and if people are beginning to flee China, we need to make sure that the big producers of clothing for retailers around the world come to India. We also need to make sure that Indian branded manufacturers find ways of taking their branded clothing and textiles from India to the world. Either that, or that they collaborate with the big retail chains around the world to sell their products on a commodity basis. Instead of branded stuff, they sell massive volumes. But that would mean a huge ramp up of capacity, doubling, tripling of capacity over the next 2 or 3 years in textiles, garments, shoes, toys, etc. That is not happening yet. And in fact, it's not, I mean, to put it mildly, if you look at textile and garment exports from India in the last 10 years, they've been stagnant, no improvement. So that has to change. This year, garment exports are up 11%. So this year, it's a little bit better, but 11% is not transformative growth. You need 20, 30, 40% growth when you see massive amounts of investment coming in. Exports just take off. That's what happened in Korea and Taiwan in the 1960s. In textiles, it happened in Japan in the 1950s. In textiles, we don't think of Japan as a clothes manufacturer, except Uniqlo. But Uniqlo produces all its clothes in China and sells it under a Japanese brand. But in the 50s, you had absolute takeoff in Japanese exports of textiles and garments. In the 60s and 70s, that happened in Korea and Taiwan. When you have that sort of takeoff, where you have 40, 50% annual growth, 40 to 50% annual growth, then you very quickly achieve full employment. You achieve you basically start sucking surplus labor away from agriculture into labor-intensive manufacturing. And as you get this, you get 200 or 300 million people employed, then that transformation occurs. And 200, 300 million people employed in manufacturing get used to the idea of being manufacturing workers. And then they move up the value chain into different kinds of more advanced manufacturing, which is what happened in Korea and Taiwan in the 70s and in the late 70s and through the 80s and 90s. Mm-hmm. So if you have that, then you can really see spectacular economic growth. Sadly, so far it's not happened. Mm-hmm. And I think a lot of what the government needs to do has been done. I think one thing that is required is that the labor reforms that have been passed by Parliament and signed by the President must be notified and must be implemented. As I say, laws are passed and then they don't get gazetted for years. There's one law I talked about previously, 28 years it took before it was gazetted. So we don't have the luxury of time. Frankly, this 15 to 20-year window of a declining dependency ratio, the big structural benefit that India has, is there only for that 15 to 20-year period. If we take full advantage of it and achieve a labor-intensive manufacturing transformation, then we will be a high middle-income country in 15 years' time. And our country will be transformed. We won't be able to recognize the nation that then emerges at the end of that 15-year period. It'll be, and if you go to Seoul, Korea today, or if you went to Tokyo 25 years ago, actually you go to Tokyo now. I mean, it's beautiful. It's a clean, green, beautiful city, and that transformation can happen. I mean, India has the potential to do it, but we need to collaborate with the likes of Japan and Korea. Those countries that have done this before need to be our partners. So we have partners. I mean, Hyundai is an Indian partner. Suzuki is an Indian partner. Suzuki makes much more money from India than it makes from Japan. Mm-hmm. Suzuki is a big player in the Japanese market, but in India, it is it has half the market share in Indian cars. Hyundai, of course, is another case. Now, we need these partners and learn from their broader experiences and grow faster. But I think labor. I'll keep saying this every month. Labor-intensive manufacturing is really the key, and we are nowhere near getting that done yet, unfortunately.
Fingers crossed. Let us pray that India becomes the world's, top-performing economy in this decade. As you,
we are sure to be the world's top-performing economy. There's no doubt about that. We will be the top, fastest-growing economy in the next 10 years. But it will not suffice to grow 6.5% to 7%. You have to try to grow 9%, because this is this 15-year window doesn't come back. You get that once.
Yeah.
And during that 15-year window, if we can grow 9 to 10% a year, then we will transform the economy very quickly, and we will become more like an East Asian country at the end of that period. If not, then we will be, if you look at say Malaysia, right? Malaysia is a high middle income country, but there are parts of Malaysia like Kelantan and Terengganu that are much less prosperous. You could be like that, or you could be like some parts of Thailand outside Bangkok. I mean, Bangkok is quite a prosperous place. Or you could be like, say, parts of Indonesia today. So, getting to that point is still a big improvement on where we are now. But to become like what Seoul is today, Seoul, South Korea, or even Busan, South Korea, those places, then you can have real K-pop type situation where your culture is adopted by the world.
Thank you, Mr. Basu, for being with us. I appreciate your time, sir.
Thank you, as always.
It's time to wrap up the show. Thank you for watching. Please do subscribe to our YouTube channel, and please post your queries in the comments section below, and also let us know any other topic that you want to take up for our next session. Thank you again for watching.